Hey traders, this is Christian from Tribeca Trade Group with your weekend market review, and we're going to do a macro review. Today is Saturday, it's the day before Easter, so just wanted to wish everybody a happy Easter and Passover, and a great time to kind of go through the markets. We had Friday off yesterday, and really a nice time to kind of review, take an assessment of the overall markets. Time to catch your breath because there was certainly enough market events, both market related and not market related that went on last week that caused a lot of volatility. So in this weekend's newsletter, just wanted to kind of um, do the normal, take a step back and take a look at what the markets look like, where there's market strength, where there's not. Was there further deterioration last week in U.S. sectors? So we're going to be going through all of that in this video. So first things first, just wanted to just go through some of the events last week that caused the volatility. There was, just a couple of these could have done it, but the markets were kind of hanging in there for the last couple of weeks. But more and more bad news just kind of took over, and we see some cracks in it, especially in the U.S. indices. So what did we get last week? We got a Syrian missile strike. The tensions with further tensions with Russia over Syria. We had that conference that went on last week between Russia and the Secretary of State. And at the beginning of the conference, it sounded like it was going pretty well, but it just started to go downhill. And that was Wednesday. Besides those events, well, if you want to add to that, of course, we had the MOAB bomb that was dropped in Afghanistan, and more tensions with North Korea as well, with the possible that they were saying in the middle of the week that they were possibly going to conduct a nuclear test this weekend. So we didn't get that yet. They did unveil some ICB missiles in their normal parade, I guess that they do every year. It seems like they're doing that. So, while it's not fun to kind of see that stuff being rolled out, I think they do that every year as kind of a test of their strength. So, and then there was also more about the Trump agenda getting delayed further, and the tax agenda being delayed further. We did also have yesterday. We had some economics that were released on Friday while the U.S. markets were closed. And if you remember, we got the PPI data. PPI and CPI data come out, every month, one day after another. So we got the PPI data that came in a little bit light versus expectations, and then on Friday we got the CPI data that came in decently. They were expecting 0.2%, and it came in negative zero point 0.1. So that missed. So there's no inflation that showed up for the last month. And then also retail sales also that came in line with expectations. They were expecting a negative zero point 0.2. They got it. And X auto month over month also, that was actually worse than what expectations were if you strip out auto and gas. So that was also two ticks shy there. So what does that mean? Well, 1 month is not a trend, but you could see that we're not move the trajectory of some of these data points that have been coming out have not been so positive in the last month. So, it's a little bit of a dip. So what this could mean, if you want to look for the silver lining in terms of the CPI and the PPI, these are gauges of inflation. And then also what we saw the previous week in terms of the jobs number that was also well shy of expectations. There's no rush, I think, for the Fed to raise interest rates. So that's the silver lining that you could see in this negative, in some of the negative economics that have, or less than positive negative economic data that's been coming out over the last couple of weeks, is that I don't think the Fed is going to be in a rush to raise hikes. And I think they originally said 3 or 4. Maybe we only get a couple at this point, especially with global tensions as well. I don't think they're going to be really willing to rush into raising interest rates at this point. So you can kind of put that on the back burner for now. So what I did in this weekend's newsletter is I just talked about whether some of these things that have been taking place and that have adding to the market volatility, if they are things that we need to worry about temporarily, or if they're more, if they're longer term setbacks right now. And I see a lot of them, a couple of them, of course, with the Trump agenda, it's kind of letting the some of the air out of the balloon, and kind of putting things back into reality, and it's dropping expectations for what they will get done. I think that's fine. I really don't want high expectations for what the president is or is not going to get accomplished. Let those expectations come back down, and let the market realize that. I think I'm taking that away as a positive. I just don't like when the market is really expecting so much to happen. Expectations just were too high, I think, for that. Besides that, missile strikes, this is, if you kind of look back to previous administrations, these guys have all done this before. So while it's not exactly a fun time when you're in in the middle of it, and watching these headlines roll across, and seeing the VIX drift higher, this has kind of been a normal course of business for these guys. These guys, the presidents have carried out missile strikes before. Maybe not the dropping that huge bomb that they dropped last week, but this is something that the market has come to grips with over the last 12 years or so. So I really think that these are more temporary, and I think what you have to ask yourself with all of these tensions and this kind of cat and mouse game is, there was another headline this weekend uh, about British aircraft carriers kind of closely monitoring a Russia ship that gets close to their waters. So I think this cat and mouse game is going to go on for a while. You have to ask yourself: is there going to be World War III, or do you think it's more, in a sense, for in the U.S., if we have a new president and he's looking to flex his muscles and kind of set the tone for what he's going to allow under his administration. And I think he also wants to be able to draw a line and say, if you cross it, there's going to be actions. So that's my personal take, is that I think he's just really setting the boundaries by doing some of these exercises that we've seen over the last 2 weeks. So you have to ask yourself: is World War III coming, or is this just a new president setting the tone and setting some boundaries? So if you think the former, where that's just the new president kind of setting the standards, then I think these are temporary setbacks in the market. What I've said all along is, over the last couple of weeks, is I'm really concerned about the earnings that are going to be coming out this week, and I didn't think it was really an area to have a lot of positions on, a lot of big positions, especially in options, because it's a very choppy market. So that's what I was mostly concerned with. These other events that have happened have just kind of added to it, and I think that's why the market really started to break down towards the end of last week. So regardless of which one of those two beliefs that I just brought up, there's definitely a lot more uncertainty in the market than there was a month ago, a couple of months ago, and the market really doesn't like this uncertainty. So when you see the higher the uncertainty gets, the further the VIX goes up, and more indices start to drop. I've also been watching the CNN money fear and greed index. So notice where this thing, just in last week's newsletter, we talked about it going from like a 50 to a 40. Now it's all the way down to a 25. So sentiment if we go right over here, you can see that it's a 25 right now, and that's the extreme fear right now in the marketplace. So these usually, going back over the last couple of years, whenever it seems to be extreme fear in the marketplace, it's usually a good place to buy. So am I willing to do that right now? No, not necessarily, because we did breach, and I'm going to go through some of the technicals that I've got listed here in the newsletter. But for example, a break of the 50-day moving average in the S&P and a break of the upward trend line, these are not great things to kind of go ahead and buy. I usually like to wait to see where we find support. Notice we got the 100-day moving average down there, so which is only in the S&P. The S&P closed, or the SPY closed 232.51. You got the 100-day moving average sitting at 230. That's only 2.5 handles down. We could, that could easily be just one day, and we hit the 100-day moving average, and then we'll kind of see if we can form a bottom there and see some type of price recognition or confirmation that that support is going to hold. So that's what I'm looking for. I'm not really looking to jump in with 2 feet. Although everybody's always you always have to go back to, everybody's always asking for a dip. Oh, if I can only get a dip in the marketplace, I would start buying. The problem is when we do get a dip in the marketplace, there's usually something that's is out there that is unsettling, and that's why people don't want to buy. So let this play through a little bit. We have been seeing a breakdown of indices one by one. I'm going to go into a little bit of technology and go into semis, but we'll just kind of carry the exercise. But that's what I see for the S&P. I mentioned, I think on Friday's video, you've got, depending on what you look at, if you look at moving averages, we broke the 50. That's a sell signal. If you look at value areas, which I do as well, 234.45 is what we broke. That's the April value area. We're now below that. Also, if you look at trend lines, we also broke a trend line. So you've got three different things that are telling you that a short-term trend has been broken. If you look at the Qs, they've been holding up stronger. They're right at the bottom of value, so they haven't broken the 50-day. Notice that green line, which is the bottom of value, is also coincides with the 50-day moving average. Let's see if we hold that next week. Again, they've been stronger, so they have been moving down. They did move down last week, but they're clearly not as weak as small caps and as the large caps are right now. So watch that bottom of value. That's a very easy level to watch. I think that's right around 130.40. I think that's pretty much right where we are. So we'll have to see if we violate that in the beginning of next week. IWM, which has been more of a mess, that we did break value on Friday. We've also been making now for weeks. We've been making lower highs and lower lows in IWM. We've got more support down here. So we kind of have, maybe a little bit of support here that we might hold on to. Again, these things can reverse pretty quickly. We do have sell signals across the board, but all it will take is basically one day of gains, and when we can get back into the value area for small caps. So while there's technical damage in the charts, it's not going to take us long to hit next support, and it won't take us long to really get back into that uptrend as well. So, I don't think it's time to completely throw all of your positions away. I am sitting for my cash portfolio, I've got all of my risk defined in terms of moving averages, and if we breach those, I got out of one position on Friday. I was long EWI against the 20. I had to stop just a little bit below the 20-period moving average because that's what brought me into the trade. So I'm just going to sit with my trades, and I've got my defined exits. I talk about that all the time in the Tribeca trade room. Every time I put on a position, I know exactly where I'm going to get out. So I'm not going to jump ahead and get out of the positions before they hit their stops. I'm going to sit with my positions, and if they get stopped, the stops are not way below where I put them on. So drawdowns are not fun, but having your position size and having your levels defined are not going to get me hurt too badly if we happen to go down a little bit further. Okay, and sectors, I go over sectors every week and talk about how they're kind of shaping up. It really gives a good picture of the internals of the market. You could see this is last week, so I think we had 7 sectors that were above the 50, the 100, and 200. Clearly, and this has been going on for the last couple of weeks. I talked about in last week's newsletter sector deterioration. Clearly, we had that last week, and now you only have 3 sectors that are above the 50, the 100, and 200, and those are all defensive sectors: REITs, utilities, and consumer staples. Everything else has basically fallen. Some of those, bigger chunky areas of the market, your consumer discretionary, your tech, your healthcare, these all fell below the 50-day moving average on Friday. So, we could look a little bit, we could look at the tech chart. I'm going to go over semis in just a minute. By the way, and I'm going to go over next week's. So I got a lot of stuff to go through, but I wanted to go through a couple charts. Let's see which one is not, which one is free, which screen is free. Let's look at. I mean, you can see this just happened on Friday, just barely a break of the 50-day moving average in tech. That's been one of the strongest areas of the market. You can go into consumer discretionary, and you can see as well, just barely a close, looks like just below that 50-day moving average. These charts are dividend adjusted, so they're holding up. So we'll see if this how this works at the beginning of next week, if it's going to be a clear break, or if we bounce right back above. So like I said, things have continued to deteriorate, especially towards the end of last week, but it won't take much to kind of bring us back. And then also you've got a lot more sectors that I have labeled as weak. Again, this happened very quickly. Financials showed a break last week below the 100 and 200 day moving average, even though the financials had good earnings this week. JP Morgan, Citi, those PNC, those names had good earnings, but I think A, the sentiment is so bad right now, and B, you also have to think about, as I mentioned just a few minutes ago, if rate hikes are not going to be as quick as we originally thought, some of the air is going to be is going to drain out of the balloon as well with the financials, because they were expecting, I think everybody was expecting a lot of rate hikes, and if we're not going to get them, that's not going to be good for the financials. So I think that also, even though the banks did fine with earnings last week, financials sold off on Friday, and I think a lot of that is because of interest rate expectations. All right. So last week's performance, pretty dismal. I don't want to go over this too much in detail, but you could see your defensive areas outperformed and your riskier sectors definitely underperformed. All right. So I want to talk about fund flows, because sometimes this kind of gives us a hint of what's been going on. Are people kind of running for the hills right now in terms of pulling money out of the market? No, that hasn't been, generally when I compile this data, just about, I'd say that the average inflows into equity ETFs on a week to week basis are probably about $3 to $5 billion. That's how they've been run. That's the clip that they've been running for the last few years. So, keep that in mind, that there usually are inflows. The last couple weeks, actually since March expiration, there has been either outflows or the flows have been really muted, especially in the US. International ETFs have been gaining assets, but the US ones have either been seeing outflows. Like last week, for example, I think there was $9 billion that came out of, not, and that's not last week, that's 2 weeks ago. There was $9.1 billion of equity outflows in the US. What was it last week? They were basically flat last week. So it just seems like there's a bit of a buyer strike, and we do see from time to time, outflows in U.S. equity ETFs. We've seen them now for, we've seen those for a couple weeks out of the last like four weeks, but I'm not seeing anything besides that one big week of the outflows, the $9.1 billion, and that was mainly in the SPY ETF. There hasn't been just money that the money that went in November and in December were huge inflows. So we're not seeing all that money being unwound. We're just not seeing a lot of money be put to work either. So that's pretty much the story there. International ETFs still are leading the way. What did they see for last week? They saw $3.3 billion. In terms of fixed income ETFs, we're also not seeing a ton of inflows there either. There was $1.6 billion last week. That's not a huge number, so it doesn't tell me that really there's a rotation going on. It just seems to me more like a temporary pullback, and I think that's what we had. On the other hand, I would say, in gold, gold really saw a lot of inflows last week, $514 million. So while the bonds are not seeing the big money being added, definitely GLD and IAU saw some decent sized inflows last week. And then just also in U.S. sectors, I would say you could see just from this chart alone, pretty much risk off. Money coming out of financials, money coming out of energy, materials. and some small money going into consumer staples, healthcare, and REITs. Also a little bit into utilities as well. So that's pretty much the picture that we've been seeing. I'd say the last 2 weeks. I would say not complete fear, and not a complete rush out of equities, but certainly I would call it a buyer's strike. So next, semis have been one of the strongest areas of the markets. They've been in a huge uptrend for the last year. They started to break down just towards the end of last week. I say middle to the end of last week. Look at the volume that occurred, kind of confirming the break here. There was some really large outflows that happened for the week. It was $362 million of outflows in the SMH ETF. That's a really big chunk. That's actually 53% of the ETF. So half of the size of SMH taken off last week. We also saw a decent put buyer on Wednesday. We saw 25,000 of the SMH April 76 puts for 53 cents. I think they made some nice money on that trade from Wednesday to the end of the week. So a couple things to note here. Are semis done? Well, a couple things that I noticed is number one, this SMH, they didn't go out really long term in the semis ETF. They went out basically just a week and a half. So they're looking for short term volatility, really not long term volatility. Of course, they could always roll that position out and roll the gains over, but it tells me that they were looking for a big short term move. Also, every time that we have seen this volume in the past, kind of look at the price action, what's happened after this volume. So it seems like the kind of the weekends or a big unwinding happens, and then it takes a few days and semis get right back into the trend. So what to kind of watch to see if this is going to be a buying opportunity? I'd watch the 100-day moving average, see if that holds, and see if we can get back above the 50. That's really what I'm thinking. I'm thinking that this is more of a short-term move, but again, that's just me making a prediction. And really, what you want to watch is the technicals. But just keep in mind, every time the volume has spiked up like this before, it has represented a buying opportunity. So that's what I'm looking for, and I'm going to look for the reclaiming of the moving averages as confirmations for my thought. Just a couple other charts here. I talked about EMB. Again, I like emerging market bonds. They saw inflows last week. They actually saw almost as many inflows as happened in the U.S. in terms of bonds. So again, the bond inflows are not all going into treasuries. They're going into various different places in the market. And then lastly, I want to talk about what's trending up. I'm always looking for new trends, and we see GLD. GLD broke above the 200-day moving average. Silver did the same thing as well last week, broke above the 200-day moving average. I like longs with defined support. If so, gold right now represents a long to me, and your stop would be right below the 200-day moving average. I'm also watching GDX, the gold miners ETF. That's right also at the 200-day moving average as well. So that's setting up for a long there as well. Silver, mentioned just like gold over the 200-day moving average. And a couple miners to look at in this space that I've got my eye on, because there is a silver ETF, silver mining ETF, but it's decently below the 200-day moving average. I like PAAS, which just popped above the 200-day and the 50-day, and then also HL, kind of an ugly looking candle on Friday. So we'll see what the price action does on Friday. Other events to watch for next week. We've got to start the week. We talked about Friday's data. We've got Empire Manufacturing. We've got some housing starts, which have been pretty positive. So this will be something notable to watch. Is if we've been seeing a couple things, a couple cracks in terms of economic data. Just as I mentioned, retail sales was a couple ticks lower than expectations. So housing data has been pretty strong over the last couple of months. Let's see if that continues, as housing stocks have been one of the best areas of the market year to date. So keep an eye on the housing starts and building permits. We also have industrial production that comes out. So these will be some good gauges if there's going to be further missing of U.S. economics, or if possibly some of the recent downticks that we've been seeing are just temporary. We also have existing home sales, and then also, which I think is going to be the most interesting, is we're really starting earnings season to kick off. We saw a couple names report last week, and I think really this is going to hold the next direction of the market, is whether or not some of the bigger names that report are going to meet or exceed expectations, or miss. So I think, I've been saying this for the last couple weeks that I was expecting a choppy market, and I'm really waiting for the first third of the S&P 500 names to report, to see if that's going to be a signal that the market wants higher. And again, the earnings reports have to justify the price. So that's what I'm looking for, especially next week. So I think you just want to be patient and wait for some of these results to come out, and then wait for, as we've seen a couple technical levels get violated last week. You want to wait for those to be reclaimed, and that's what I'm watching for next week, and also not jumping in too early to buy the dip right now. So that's it for today's video, this weekend's video. Thank you for watching, and enjoy the rest of your weekend. Have a great Easter, as well as Passover as well. Thanks again.